I want to start with something that I think changes everything about how you should be reading what is happening in the gold market right now. Gold is at $4,428 per ounce today, March 28, 2026. Down 21% from its all-time high of $5,596, reached on January 29th. And I have spent the last 48 hours going through the data, the vault flows, the central bank disclosures, the IMF filings, and the London bullion market reports. And what I found is not what most people are being told. Most people are being told that gold is falling because the dollar is strong and yields are high. That is true, but it is incomplete. There is a second force operating in this market that Wall Street saw coming, and almost nobody explained to regular investors. And until you understand it, you cannot understand why the reset that is coming, the one I am calling the biggest reset yet, is going to be so much larger than anything that has happened in this bull market so far. Turkey's central bank sold and swapped about 60 tons of gold, worth more than $8 billion, in just 2 weeks after the start of the Iran war. That is not a portfolio adjustment. That is a central bank being margin called by a war. Let me explain exactly what that means, and why it matters to every person who owns gold, silver, or any precious metals right now. Subscribe now. Here is the mechanism, step by step, because this is the part nobody is explaining clearly. Turkey imports approximately 90% of its oil and 98% of its natural gas. When the Iran war began on February 28th, and Brent crude went from $75 to over $100 per barrel, Turkey's annual energy import bill increased by approximately $20 billion. Not gradually, immediately. Because energy contracts are priced in dollars, and Turkey needs dollars, not lira, to pay them. The Turkish lira hit a fresh record low against the dollar at least 11 times since February 28th. 11 times. In 16 trading days, the currency is in free fall. And Turkey's central bank has to defend it, because if it doesn't, inflation, which is already at 37%, accelerates further. Political stability erodes, the economic system fractures. So Turkey faces 3 options, all of them painful. Option 1, let the lira collapse. Political suicide, not happening. Option 2, burn through dollar reserves. Already doing that, already low. Option 3, sell gold. Take the dollars from that sale. Use those dollars to defend the currency. JP Morgan estimated that precious metals worth around $30 billion out of Turkey's total $135 billion in assets held at the Bank of England could be used for such operations. Turkey chose option 3. 60 tons in 2 weeks, $8 billion. That is not a strategic decision. That is a forced liquidation. A margin call. Except instead of a retail trader getting a phone call from their broker, it is a sovereign nation being forced to sell its gold reserves to defend its currency peg in a war it did not start. Here's where things get important. Turkey is not alone. And this is the part that I need you to understand before you make any decision about your own gold position. Russia's central bank began selling gold in 2025 to finance war expenditures, raising approximately $2.4 billion through February 2026 and reducing its holdings to a 4-year low. Poland's central bank, the most aggressive gold buyer in the world over the past 3 years, has proposed monetizing approximately 550 tons of its reserves for defense spending. $13 billion. The governor outlined the proposal in early March. Poland represents a different but directionally consistent risk, from net buyer to seller in waiting. China's People's Bank paused gold purchases in Q4 2025. India's central bank became a net seller in January 2026 as the rupee came under pressure and the RBI needed liquidity. Think about what that list represents. Turkey selling, Russia selling, Poland considering selling, China paused, India selling. These were the most active buyers of the gold bull market. Together they represent a simultaneous shift across multiple official sector participants, from net buyers to net sellers, or sellers in waiting. And here is the question I have been sitting with all week. If the central banks that drove gold from $1,800 to $5,596 are now selling, what comes next? The answer, when I look at the data carefully, is the opposite of what most people instinctively assume. And this is the part of the story that I think is genuinely the most important insight I can give you today. Let me explain what a reset actually is, because I have watched 4 major resets in the gold market in 40 years of managing capital. 1976, 1983, 2008, 2013. And every single one of them followed the same pattern. Forced selling hits the market. Not strategic selling, forced selling. Central banks that spent years accumulating are suddenly compelled to liquidate because a crisis has destroyed their dollar inflows, and they need cash to survive. The gold price falls significantly. Retail investors, seeing the price fall, conclude the bull market is over. They sell. That adds to the selling pressure. The price falls further. And then, when the forced selling exhausts itself, when the crisis that triggered it stabilizes, when the dollar demand that the oil shock created normalizes, the structural buyers return. The central banks that were forced to sell do not abandon gold as a reserve asset. They sold because they had no choice, not because they changed their strategic view. And when they can buy again, they buy. The fiscal and currency constraints driving Turkey and Russia's selling are conflict-specific, not policy shifts. If Hormuz traffic recovers and oil retraces toward $85 to $90, lira pressure moderates, intervention selling slows, and the medium-term supply picture normalizes. The long-term demand floor remains structurally intact. Reserve diversification away from dollar assets, ongoing geopolitical fragmentation, and fiscal deficits in developed markets continue to provide the conditions under which central banks have a structural incentive to hold gold. This is the reset, not the end of the bull market, the clearing of the excess, the forced liquidation that creates the conditions for the next, larger move. And I want to be precise about why I am calling what is coming the biggest reset yet. In 1973, when gold began its historic bull run, the United States national debt was approximately $500 billion. Today it is $39 trillion. That is not a larger version of the same thing. That is a categorically different fiscal reality that creates a categorically different structural demand for gold over the long term. In 1973, no central bank was buying gold strategically. The institutional infrastructure for sovereign gold accumulation, the swap lines, the vault systems, the swap agreements at the Bank of England, barely existed. Today, central banks are forecast to purchase roughly 850 tons of gold in 2026, almost the same as last year, and still historically elevated far above the pre-2022 average of 400 to 500 tons. In 1973, there was no silver supply deficit. There was no AI infrastructure driving industrial metals demand. There was no de-dollarization movement of the scale we are witnessing now. And here's the fact that I keep returning to. When the US and its allies froze Russia's currency reserves in 2022, policymakers across the developing world took note. If your reserves can be frozen with a keystroke, they're not really yours. Gold, however, is different. It has no counterparty risk. It can't be printed, devalued, or sanctioned. That realization did not change when Turkey was forced to sell 60 tons to defend its currency. Turkey still knows that gold cannot be frozen. Turkey sold gold because it needed dollars in a crisis, not because it decided gold was no longer a strategic reserve asset. When the crisis passes, Turkey will buy gold again. Because the strategic logic that drove its accumulation over the previous decade has not changed. The same is true for Russia. The same is true for Poland. The same is true for every central bank that has been forced into selling by the dollar demand created by the Iran war. This is not the end of the gold bull market. This is the biggest, most dramatic reset within it. And resets, by their nature, create the most significant buying opportunities in any long-term trend. Now let me tell you what the three-phase playbook looks like from here. Because I want to give you something concrete and actionable, not just a macro framework. Phase 1 is what we are in right now, the forced liquidation phase. Gold is trading near $4,428 per ounce on March 27-28, 2026, down 21% from its all-time high of $5,596, reached on January 29th. The sellers are not making strategic decisions. They are meeting obligations. Turkey is defending its currency. Russia is funding a war. Poland is considering defense spending. The selling pressure is real, it is large, and it is, by definition, finite. Countries cannot sell more gold than they own, and the gold they are selling has a bottom. The question I am asking to determine where that bottom is, how much forced selling remains? The Central Bank of Turkey reported a combined drawdown of 58.4 tons across 2 weekly reporting periods, 6 tons in the week of March 13th and 52.4 tons in the week of March 20th. JP Morgan estimated precious metals worth around $30 billion could be used for further operations. That is a number with a ceiling. Turkey does not have infinite gold to sell. Saudi Arabia's official holdings, approximately 323 tons, appear unchanged per latest IMF data with no confirmed sales. The UAE holds approximately 11 tons. Kuwait holds approximately 79 tons. The Gulf state selling that has been rumored is not confirmed in the IMF data. What has been confirmed is Turkey and Russia. The speculation about broader Gulf state selling may be adding downward pressure through sentiment rather than actual supply. Phase 2 is the stabilization phase. This begins when oil stabilizes, when the combination of Saudi pipeline capacity and alternative supply routes absorbs enough of the Hormuz disruption that the emergency dollar demand from energy importing nations begins to moderate. Trump has been making noises about Iran negotiations, talks which were already said to be well underway, according to the president on March 26th, though flatly denied by Tehran. When oil stabilizes in a range of $85 to $95, the marginal dollar demand that is forcing Turkey's hand diminishes. The lira stabilizes, the forced selling slows, and the gold market begins to recalibrate toward its structural price rather than its crisis liquidation price. Phase 3 is the structural re-entry. This is when the central banks that sold during the crisis begin to rebuild. Not immediately, but within the 12 to 18-month window that historical resets have typically taken to complete. China and India have not signaled any reduction in their accumulation programs. The PBOC extended its gold purchases for 15 consecutive months through January. The strategic buyers have not left. They have paused or been forced to sell temporarily. When they return, and the structural logic I described tells me they will return, they return to a market where the forced selling has already occurred, where the price has already reset, where the accumulation opportunity is larger than it was at the previous highs. And then there is Russia's April 2026 deadline. Russia is banning gold exports from April 2026, making it illegal to export gold bars above 100 grams. Every Russian gold holder who wants the ability to move their assets freely has a window of days to sell into the international market before that window closes. That selling is adding to the near-term pressure. But when it exhausts itself, when the Russian pre-deadline liquidation is complete and the export ban takes effect, a significant source of current selling pressure is removed permanently, and a significant producer of gold is simultaneously locked out of the international market, tightening future supply. Let me close with the two things I am watching most closely to identify when phase 2 begins. The first is the Turkish lira. The lira has hit a fresh record low at least 11 times since February 28th. When the lira stabilizes, when the pressure on the Turkish central bank to sell gold to defend the currency diminishes, one of the two largest confirmed sources of selling pressure in this market will have turned. Watch the USD-TRY exchange rate. When it stops making new records, watch gold. The second is the Hormuz situation. Every week the strait remains commercially disrupted is another week of elevated dollar demand from energy importing nations. Every week oil stays above $100 is another week that forces Turkey's hand, drains Gulf state dollar reserves, and pushes central banks toward liquidation. Watch Brent crude. Watch tanker traffic data through the strait. When oil falls toward $85 to $90, the fundamental driver of this entire forced selling sequence begins to moderate. I will tell you what I genuinely believe about what happens when both of those stabilize. JP Morgan has raised its gold price target to $6,300 per ounce by end of 2026, with an $8,000 upside scenario on the table. Those targets were set before Turkey's $8 billion sell-down. They have not been withdrawn. The institutional research departments that set them are not watching the gold price fall from $5,596 to $4,428 and concluding the structural case has changed. They are watching forced liquidation create the buying opportunity that comes before the biggest reset yet. I have been through enough of these cycles to say this with some confidence. The forced selling does not change the destination. It changes the price at which you can get there. The biggest reset yet is not something that happened to gold in January. It is something that is happening right now, in late March 2026, as Turkey sells its final tons, as Russia approaches its export deadline, as Poland debates whether to monetize its reserves, and as China waits patiently with its accumulation program intact. The reset creates the floor, and the floor, wherever it ends up being, somewhere between $4,000 and $4,500, based on everything I am reading in the data, is the launching pad for what comes next. Watch the lira, watch Brent crude, be patient, and do not let a phase of forced liquidation that you now understand make you miss the biggest move yet in the gold bull market.